Welcome to the Deep Dive. If you need a shortcut to being instantly well-informed, well, you are definitely in the right place. Today, we are strapping in for the Q3 2025 earnings conference call for Amphenol Corporation. And this wasn't just any earnings call. This was really a signal to the market delivered intraday that sent the stock soaring.
That's exactly right. A perfect way to frame it. This deep dive is all about abstracting those core drivers, the specific financial mechanics, the M&A acceleration we saw, and the fundamental sector tailwinds that generated one of the cleanest beat and raise quarters, frankly, that we've seen in this cycle.
Yeah, it really stood out.
We're looking at what made this company just, jump off the page for investors.
Okay, let's unpack the results snapshot then, because the headline numbers were truly staggering. We saw non-GAAP adjusted earnings per share land at $0.93. Now, that's a substantial beat against a consensus estimate hovering around, 79 cents?
Yeah, about 79 cents, a solid beat. But the magnitude of the top-line outperformance was arguably even more dramatic. Revenue came in between $6.19 billion and $6.2 billion.
Huge numbers.
Think about that. Consensus estimates were closer to $5.5 billion. They crushed expectations by nearly $700 million right at the midpoint.
That kind of outperformance is just staggering. But here's what validates the quality of the quarter for you, I think. The growth metrics. They reported 53% growth year over year in US dollars, okay, but 41% of that was organic growth.
Exactly. And that tells you the underlying business, separate from any acquisitions, is just running exceptionally hot.
Right.
It confirms the sentiment. This wasn't some accounting trick or purely an M&A lift. This was broad-based, strong fundamentals. And we know the primary engine, it's heavily linked to that continued acceleration in demand for artificial intelligence infrastructure.
AI.
When the market sees 41% organic growth and record profitability, well, it signals high confidence. That's why the stock reacted so enthusiastically, jumping like that pre-market.
Speaking of profitability, let's dive into the operational narrative. They reported a record operating margin of 27.5%. Now, at these speeds, north of 50% year-over-year revenue growth, you usually start seeing integration costs, maybe supply chain strain or pricing pressure hitting margins.
Yeah, you'd expect some compression.
But they pulled off a 560 basis point improvement from the prior year and 190 basis points sequentially. How did they do that without hitting a ceiling?
That is the crucial question, isn't it? And the answer points directly to operational excellence.
Yeah.
Management's explanation was simple, but powerful. Strong operating leverage on significantly higher sales volumes.
Right.
The increase in revenue was just so dramatic and efficient that it completely overwhelmed the kind of diluted impact of recent smaller acquisitions. Essentially, the massive scale of that new AI business just dropped straight to the bottom line.
Wow, and that efficiency wasn't just theoretical, right? They demonstrated phenomenal financial health, great capital management. I'm looking at operating cash flow hitting $1.5 billion. That's 117% of net income.
Very strong conversion.
And free cash flow at $1.2 billion, 97% of net income. That cash conversion quality gives them immense flexibility.
It absolutely does. I mean, they have total debt of $8.1 billion, but the net leverage ratio is super low, 0.7 times, very manageable. They're sitting on $10.9 billion in total liquidity, and while they are using it, they repurchased $153 million in shares, which is, pretty standard for them.
That's standard stuff.
But the real show of confidence was the dividend. They announced a substantial 52% increase in the quarterly dividend to $0.25.
52%.
Yeah. Effective in January 2026. I mean, that is management putting their money where their mouth is. It reflects a strong belief in sustained future earnings.
Okay, let's tie this operational excellence back to the segments for a minute. Because the performance wasn't uniform across the board, but that's kind of the story of AI concentration right now, isn't it?
It really is.
The Communication Solutions segment, ACS, saw a near doubling of sales, 96% growth in US dollars, with an astounding operating margin of 32.7%.
32.7. If you want to know where the AI wave is landing, boom, it's in ACS. Now contrast that with the Interconnect and Sensor Systems segment, AIS. That delivered a more, let's say, traditional 20% operating margin.
It's still good, but not 32.7.
Right. AIS holds more of the legacy industrial and military components. What's fascinating, though, is that even within that slower segment, the team achieved an impressive 30% sequential conversion margin on incremental sales.
So interesting.
So that just demonstrates that the operational discipline we talked about, it's really baked into the entire company culture. It's not just in the high-flying segments.
Okay, that makes sense. Now let's pivot a bit from organic growth to strategy. This strong financial position is clearly fueling some aggressive M&A execution. They closed the Rochester Sensors deal, a smaller industrial bolt-on, back in August. That's kind of business as usual for Amphenol.
Right, that's the continuous acquisition strategy they've really mastered over the years, bolt-ons. But the sheer scale of the pending deals is what's really shifting the landscape here. The Trexen acquisition, that's the $1 billion cash deal for defense and high-reliability interconnects, that's still expected to close by the end of Q4 2025.
Okay, standard timeline there. But here is where it gets really compelling, I think. The timeline for the mammoth $10.5 billion deal for CommScope's CCS business was accelerated.
Yeah, pulled forward.
Management now expects it to close by the end of Q1 2026. That's a quarter sooner than they previously communicated. Accelerating a deal of that size, especially when you're integrating something so massive, I mean, that signals not just confidence, but almost certainty in their ability to handle the complexity.
It's a massive statement, absolutely. And look at the source of that confidence, IT datacom. That's the market where all these interconnects are ultimately headed, right? It represented 37% of their sales and grew 128% organically.
128%, just incredible.
Yeah. Management is clearly securing business across the entire AI ecosystem. They're specifically focusing on the high-speed, high-power, and fiber optic interconnects required for these future platforms.
So AI is the engine, clearly, but the diversification provides some resilience. Beyond datacom, organic growth was pretty solid across nearly every other market, too.
That's right.
Defense was up 23% organically, and they expect another sequential bump in Q4. Automotive showed double-digit organic growth in Europe. Really, the only lag point was mobile devices, down 3% year over year.
Which, isn't too surprising given that market. And that brings us neatly to the forward outlook. The Q4 guidance reflects continued strong momentum, but it wisely acknowledges some moderation from that record Q3 peak. Can't keep that pace forever.
Right, some normalization.
They guided Q4 revenue to $6.0 billion to $6.1 billion and adjusted EPS to $0.89 and 91 cents and 91. Still very strong numbers.
And what does that imply for the full year then? They must have raised the target significantly.
Oh, yeah. They raised the full year 2025 sales target to a huge range, $22.66 billion to $22.76 billion. That translates to 49% to 50% growth year over year for the full year.
Wow.
They did note the Q4 implied margin is slightly moderated from the record Q3 level, as we said, but they attribute this mostly to, normal revenue seasonality and simply the costs like headcount, capital expenses, kind of catching up with the rapid, explosive sales growth they saw mid-year.
Okay, that makes sense. But it does raise an important question one management must have anticipated. If 27.5% margins are record-setting, how sustainable are they really? Once the explosive growth maybe normalizes a bit, what's the structural competitive moat that defends those margins?
Yeah, great question. And they tackled this directly with what they called the complexity story. Management believes that increasing product complexity, think high-speed requirements, high-power needs across all their end markets, actually add significant value for their customers.
So complexity is good for them.
Exactly. It allows them to sustain structurally higher margins because it's just plain difficult to make these intricate connectors and sensors efficiently and reliably. That difficulty acts as a huge barrier to entry for competitors.
And that complexity is directly tied to the power story in data centers, which, let's be honest, is where the real money is being made in AI infrastructure right now.
Precisely. AI racks are moving to much higher wattages, 2 or even 3 times previous levels. This requires specialized, high-reliability power systems. And Amphenol's competitive advantage here stems from decades of expertise in military and industrial high-power systems.
Right, yeah. Wow.
They focus intensely on efficiency and safety, specifically by reducing what's called millivolt drop.
Okay, explain that for the non-engineers listening. What does reducing millivolt drop actually mean in the real world? Why does it matter?
Sure, think of it this way. Millivolt drop is essentially wasted energy. It's electrical resistance in the connector or the cable that turns precious power into unwanted heat.
Heat. The enemy of the data center.
Exactly. In these massive AI data centers, excess heat is the absolute enemy. It drives up cooling costs, it limits density, it causes failures. By reducing the millivolt drop, Amphenol ensures less energy is wasted as heat. Their connectors run cooler, more efficiently, and more safely. And that expertise becomes absolutely vital when you're talking about powering racks that consume hundreds of kilowatts each.
So their long-term military and industrial heritage is translating directly into, like, the bleeding edge of the AI data center.
That's fascinating. How do they maintain the quality needed for these hyper-delicate products while scaling up so incredibly rapidly?
That's where their automation capabilities come in. This was another key point on the call. They emphasized their extensive, homegrown, decentralized in-house automation capabilities.
Homegrown and decentralized. Okay. Yeah, because they don't rely heavily on external vendors for custom automation machinery. They can quickly iterate on designs, they can shorten the manufacturing cycle time, and they can rapidly ramp up volume production, all while maintaining the incredibly high performance standards these complex, high-speed interconnects demand. It's a really key part of their operational advantage, often overlooked.
Okay, so pulling it all together, what does this all mean for you, the investor? Maybe looking longer term. The thesis seems incredibly strong right now. What are the immediate catalysts or things we should be watching closely?
I'd say three main things to watch. First, the regulatory and closing milestones for those big M&A deals. Trexon is expected this quarter, Q4. And that accelerated CCS deal, now expected by the end of Q1 2026. Any hiccups there would be notable.
Oh, deal execution.
Second, the actual pacing of the AI rack deployments. Will the speed of data center build-out continue at this rate, or slow down, or maybe even accelerate further? That directly impacts their core growth engine.
Right, the macro environment for AI build-out.
And finally, just keep an eye on the cadence of capital returns under that new, much higher dividend. Does it signal continued confidence? Do they keep buying back stock? It tells you about management's view.
Got it. Okay, now, a necessary word of caution before we move on. The following segment is purely for informational and entertainment purposes. It's based on our analysis of the earnings call and the related materials we've discussed. This is absolutely not financial advice, and you should always, always conduct your own research before making any investment decisions. Seriously.
Understood. And disclaimer heard loud and clear. So given the exceptional operational execution we've talked about, those record margins, the cash conversion, that whopping 52% dividend hike, the market is clearly pricing in the strong AI-driven organic growth. That seems baked in.
Yeah, you'd think so after that stock move.
But I suspect the market is still attaching a significant, let's call it an execution risk premium to the massive $10.5 billion CommScope CCS acquisition. There's probably still some skepticism out there about integrating something that massive successfully.
So you're saying the market might be underestimating management's proven ability to pull off complex M&A integration. They have a track record.
Precisely. That's the angle. My outrageous but plausible proposition is a long-term options play, betting specifically on the successful integration and the margin realization from that CCS deal. Look, management has shown a competitive advantage in driving margin expansion in acquired assets. They've done it before consistently. If they can apply their operational discipline to the CCS business effectively, well, that risk premium should disappear over time.
Okay, interesting. So what's the trade idea specifically?
Maybe something like long-dated call options, perhaps targeting a January 2027 expiry, giving them plenty of time to integrate. And you'd be betting on a significant share price move, say above $150 or whatever target makes sense after doing your own work. But the core idea is this. It's an explicit bet that once CCS is integrated, and that subsequent margin step-up becomes clearly visible in the numbers, the stock gets a premium re-rating, not just based on ongoing AI demand, but on proven operational excellence and integration.
Fascinating thesis. A bet on management's ability to execute some pretty complex corporate surgery there. Okay, to quickly recap this incredible deep dive then. Amphenol delivered a massive EPS and revenue beat, highlighted by that stunning 41% organic growth.
Huge numbers.
They accelerated the timeline for the massive CCS acquisition, signaling extreme confidence. And they reinforced a structural margin story, arguing that increasing technology complexity, particularly around high-power AI demands, makes their product set fundamentally more valuable and defensible.
Yeah, this call really felt like it confirmed the shift from just a cyclical recovery story to genuine secular structural participation in the AI infrastructure build-out. They are a key enabler. So the long-term question for you to consider, I think, is not really about demand anymore, but about velocity. Yeah. Will the sheer speed of AI innovation and the constant architectural shifts maybe outpace even this company's proven ability to seamlessly integrate new, very large assets like CCS, while still maintaining those premium 27.5% plus operating margins?
That's the challenge, right?
That is the ultimate test, I think, for the entrepreneurial culture they always boast about? Can they keep it up at this new massive scale?
A great challenge indeed for a company that seems to be firing on all cylinders right now. Thank you for joining us for this deep dive into the Amphenol Q3 call. A lot to think about there. And remember, this is informational only, absolutely not financial advice. We'll see you next time on The Deep Dive.